Hello and welcome to On-Chain Reaction. I'm your host, James Bennett, and I'm the CEO of ByteTree. Applied data for digital asset investors. So this week, I'm going to walk you through some on-chain data, specifically looking at the mining industry. On the first slide here, we can see that miners over the last month or so have been earning around $11 to $12 million per day in revenues. This is really good news for the network after the Bitcoin, the last halving in May, saw the block reward drop from $100,000 per block to $50,000 per block. So despite the block reward halving, miners have been able to sustain a very good level of revenue, and this has been made up by an increase in fees. The blue line here shows a 14-day moving average of fees as a percentage of total revenues. We can see that it currently sits around 10%. Now, while this is positive for the long run in terms of creating an incentive for miners to be active on the network, it's slightly concerning from a usability point of view. In my view, it's good to see fees at around 2 to 5% of total revenues, but when we get to around 10%, it can act as a disincentive to users who might seek other payment networks like Litecoin or Dash in order to send their transactions. This is a metric we need to watch closely as time goes on. So we can see then that fees are rising and miners are able to sustain their revenues. This next slide here shows us the impact that has had on the total difficulty level of the network. Now remember, as more compute power is added to the network, the protocol, the Bitcoin protocol, adjusts the difficulty upwards. So it's an automatic adjustment that's programmed into Bitcoin in order to make sure that block times are consistently around 10 minutes, and we'll come to that in the next slide. But before we do that, I just want to show you here, in the dark blue line, we're seeing the marginal revenue that a miner gets every time they mine a block. So around every 10 minutes, this is how much a miner receives in revenue. We can see that that's been trending up since the May 20 halving and currently sits around $80,000 per block. Now, if your marginal revenue that you can earn is increasing, let's say ceteris paribus costs are remaining flat, then that means actually your profit margin is also increasing. And what does that do in a free market? Well, it encourages more compute power, more actors to come and compete for those profits. And that's exactly what we can see happening here with the difficulty level. Marginal revenue brings in more miners, that brings in more compute power, which then drives the difficulty up. And we're currently seeing difficulty hit all-time highs for the third or fourth time this year so far. It's really positive news, again, for the longevity of this space, because the Bitcoin network requires a very distributed and computer-heavy infrastructure to be in place for all the different applications that we'd like to use it for. So as we move to the next slide, we can see that relationship I talked about with block times. So the dotted horizontal line shows us where the standard, we call it a retargeting time, sits, which is about 10 minutes per block. Now that dark blue line that's overlaid on the dotted line is the actual block time on a 14 moving average basis. When we see periods that consistently seeing block times below that 10-minute level, it means new capital expenditure and operational expenditure is being invested into the network. And vice versa, when block times go up, so take longer than 10 minutes, it means people are holding back on mining the chain. That typically happens when revenues drop sharply, which is associated to price. So you can see there, the grey line is the Bitcoin price. Those two peaks in April, well, actually, I guess it was March, late March, and then June, when Bitcoin had some high volatility, negative price action, and miners went offline, slowing down the block times. What we've seen over the last couple of months since July is, again, positive. That mining power is increasing, and we're seeing block times remaining below that 10-minute threshold. Okay, so now moving on to the last slide, this is one of my favorite metrics to look at, because we say, what are miners doing with all of that excess inventory that they're building? So they're holding on to it at the moment. So we can see in this miners rolling inventory chart the difference between what miners actually create, we call it generating, and what they send out for the first time. And that's first spend. And you can look at these metrics live or read more about them on the ByteTree terminal. But when we're at 100% level, it means every new Bitcoin that's being mined or generated is then being sent out, let's say liquidated for cash in order to fund operations. But what we've seen in the last couple of months is an increase in the inventory levels, so that miners are actually holding a lot of that new coin on their balance sheets, which suggests that they're not in the position that they constantly need to liquidate it for fiat in order to pay for their operational expenditure. And if we look at the news that we're seeing, across the industry, it's this maturation of the mining sector that's allowing this to happen, because it's bigger companies able to hedge their position by selling their hash rate in advance or even forwards on the Bitcoin themselves. And that means that they're not in such a hurry to sell their Bitcoin. And that's exactly what we're seeing reflected here. Now, if you've enjoyed listening to this today, then please do check out the ByteTree terminal and keep an eye out for a big report that we've got coming up with Bitstamp in a couple of weeks. If you sign up to our mailing list, you'll be able to hear about that as soon as it's ready. That's all from me for now. Have a great week. Bye-bye.